interest rates continue to stay elevated, credit is the asset of choice for many investors at the moment, with equity-like returns, but allow investors to do so while staying higher up in the capital structure. The income return for the private credit benchmark we track has increased steadily alongside the rise in interest rates and is now at its highest level since late 2014. Private credit is increasingly an important part of the debt capital market, with an estimated AUM of 1.5 trillion today. The catalyst for private credit's growth came in the aftermath of the GFC, when the Dodd-Frank Act made traditional bank lending to small-medium enterprises prohibitive. Private credit stepped in to provide flexible underwriting, swift and certainty of execution, given the availability of capital and illiquid nature of its funding base. This happened again in the last 2 years, where banks and the broadly syndicated loan markets cut back lending significantly against the rising rates backdrop and allowed private credit to step in their absence. What do we think about this part of the global credit market? First, private credit will not be completely immune from the fallout or deteriorating corporate fundamentals when a deep recession hit. A more imminent concern is the significantly higher debt servicing burdens that borrowers need to bear when earnings slow without a full-blown recession that causes a major reset in interest rates. There are some natural defenses that allows private credit to deliver strong risk-adjusted returns. The majority of funds invested are designed to be hold-to-maturity strategies. Limited liquidity also reduces mark-to-market volatilities and forced selling. The seniority of most direct lending helps to mitigate capital losses in the event of stress. Private credit managers tend to have greater control and flexibility during any workout process, with the small number of lenders, which have historically led to higher recovery values. These risk mitigants are compelling, but investors ultimately need to select the right manager to execute the strategy well. By selecting the right exposures and sponsors, have the capabilities to monitor portfolio companies, and the legal and financial expertise to ensure that the credits stay performing. Thank you for tuning in, and please join us again for our next episode of Conversation on Alternatives. My name is Bee Ling, and this is Bank of Singapore Research.